Hello traders, Ahmed here, the founder of Pro Trading University. Now, let's say that you see an advanced pattern, for example, a bat. So you see a bat pattern in front of your chart. So what do you do right now? Do you go ahead and trade it right away? No, you shouldn't do that. The first thing that you have to do is to figure out where is your stop loss. So in this video, we are going to do exactly that. We are going to talk about two ways of calculating the stop loss for the harmonic patterns. And then at the end of the video, we are going to compare them both and figure out the best type for your personality. So make sure that you stick until the end of the video. Now we are going to move into the charts. Alright traders, so the first way is the 10 pips stop loss and the second way is the ATR. We are going to start with the 10 pips, ladies and gentlemen. So the 10 pips stop loss. Alright. I will go over this very quickly because it is very simple. First of all, we identify the pattern, and as you see right here, we identified a cipher pattern. The 38.2 is barely touched right here on point B, but it is a valid pattern. So after we identify the pattern, then we identify point X. By the way guys, if you don't know where is point X, then I highly suggest you to watch my video on the cipher pattern. I will put a link for it somewhere right here. And then anyway, this is going to be point X right here, this point. So after we identify this point, then we simply go beyond it by 10 pips. So this point right here, if you notice, if you look at the right, it will come at 0.9350. Then what we are going to do is we would say, alright, 0.9350 minus 10 pips will equal to 0.9340, and it will come right here. So this is our stop loss. We are done, ladies and gentlemen. For the ATR stop loss, it is the same procedure. We first of all identify the pattern, and then we identify point X, which is right here. But we do not go beyond it by 10 pips. We go beyond it by the ATR of the entry candle. So first of all, what is the ATR? The ATR is an indicator. It stands for the average true range. And what it does, it simply takes the average range value of the last few bars. In my case, I set it to 7 candles. So the average value of those last 7 candles is going to be 18. As you see right here, when I point at it, it says 18, which is 18 pips. But we don't use this ATR. We use the ATR of the entry candle. The entry candle means the candle where the pattern completes at. So for just the sake of demonstration, let's say that this pattern actually completed right here at this candle. So what we do right now is we take this ATR, which is going to be 18 pips, and then we go beyond point X by 18. So right here it is at 0.9350 minus 18 pips will put us at 93.22. So this is your stop loss. And one last thing, when you open the ATR indicator, it is by default at 14. I use 7 because I want more recent reading on the chart. So why do we base our stop loss on point X? Well, the answer for this is because it is simply going to be our previous structure. So if the market completes at point D right here, then what is the previous structure? It's always going to be point X, and that is why this way, both of the ways we discussed are going to work only with the patterns that complete inside the X to A leg. So if we have a pattern, for example, the path will look something like this. Or even the butterfly will look something like this. So both of those patterns complete outside the X to A leg. As you see, point D is outside the X to A leg. So how do we calculate the stop loss for those two patterns? And this is exactly what we are going to do right now. First of all, let me remove all of the drawings. And we actually have a butterfly right here. X to A to B, B to C, and C to D will come around this level. So here's what we do for the butterfly pattern and every other pattern that completes outside the X to A. Like, we simply look left and see if there is a previous structure around point D. And in our case, we actually do have a structure right here. So we are going to base our stop loss based on this structure. If, however, we don't have any structure near point D, then we will simply don't trade this pattern. So here is the structure. This is the cycle high. Right, so we are going to base our stop loss based on this high right here. So I am going to draw a horizontal line at the tip of this wick. Now, we are going to use the same method we used earlier. So it can be either the 10 pips, which means we will go 10 pips above this line, or the ATR of the entry candle. So the ATR of the entry candle is going to be 16 pips, as you see below right here. And therefore we are going to go 16 pips above this line, or 10 pips above this line. And it's going to be somewhere, so 56, it's going to be 66 right here, or 72. It depends on whether you are going to use the 10 pips or the ATR stop loss. But anyway, I don't trade the pattern yet, even though I have a structure near point D. What I do right now is I make sure that I have a risk to reward ratio around 1 to 1. So first of all, we are going to draw the targets. The first target is going to be 38.2, and by the way guys, I mean a 1 to 1 or so risk reward to target 1. So what I am going to do right now is I am going to draw a short position and check the risk to reward ratio. So here's our entry point, and I use the ATR stop loss. Okay, so I would simply choose the wider stop loss. This is going to be my stop loss, and here is my reward to target 1. As you see, we have 1.48 risk to reward ratio, so I can take this trade. And I only check the risk to reward ratio for the butterflies or crabs or any other pattern that completes outside the X to A leg. Why? Because what is your definition of a structure near point D? Does it mean that the structure has to be within 20 pips of point D or within 30 pips of point D? What is our definition of a near structure? So my definition of a near structure is that if I draw the risk to reward ratio for target 1, then I will have 1-to-1 or even better, like what we have right here. That is my definition of near structure to point D. I personally use the Atr stop loss, but that does not mean that you should too. So what we are going to do right now is we are going to compare both of the ways and figure out what is the best type for your personality. Alright, so we are going to compare the 10 pips to the ATR. So we are going to start with the 10 pips. The pros for it is the first one. It's going to be we will have a better risk to reward ratio, because usually the hourly ATR is higher than 10 pips. So if we are going to use the 10 pips stop loss, we are going to have a better risk to reward ratio, and every time we lose, we are going to lose less. The second pro is that we are going to know the exact stop loss immediately, because all we have to do is figure out where it's point X and then subtract or add 10 pips. And by the way guys, we use the 10 pips in the hourly time frame. So if you are trading in the 5 minutes time frame, then you are going to use a 5 pips stop loss. If you are trading, however, on the 4 hours time frame, then you are going to use 20 pips stop loss. Anyway, let's continue. So the cons for it, the first con and the only one is that we will have a lower winning percentage, because guys, not a lot of the times, but sometimes the price goes beyond point X by 11 pips, exactly 11 or 12 or 13 pips, and then immediately turn around and hit targets. So if you use the 10 pips, then that trade will be a loser. However, if you use the ATR stop loss, then that trade is going to be a winner, and that is why we are going to have a lower winning percentage with the 10 pips. Now for the ATR, it's quite the opposite. So the first pro, we are going to have a higher winning percentage because we have a wider stop loss. Now the cons, the first one is going to be we will have worse risk to reward ratio, because as we said, usually the ATR, the hourly ATR is higher than 10 pips, and every time we are going to lose, we will lose more. And the second con is that we cannot know the exact stop loss immediately. Now guys, this is a huge one, because in order to figure out the ATR stop loss, then you will have to not only wait until the pattern triggers and take that ATR of the inter candle, but you will also have to wait for the close of the candle, because you will get the final value of the ATR after the candle closes. And sometimes guys, the patterns complete at news times, so the market can spike 50, maybe even 100 pips against you, and you don't have your stop loss yet because you don't have the the ATR of the entry candle. So what I am doing right now is that I change this rule, and right now I take the ATR of the candle prior to the entry candle. Right now I am doing a heavy research and trying to figure out the exact numbers in the comparison. For example, when we said that the ATR stop loss have a higher winning percentage than the 10 pips stop loss. Well, higher by how much exactly? 5%, 10%, 8%. So right now I am trying to calculate all of those numbers. And once I finish my research, I will do a whole video explaining the results that I got. So make sure that you watch that video, and you might want to subscribe so you make sure that you don't miss it. And alright, this concludes this video, and as always, plan your trade and trade your plan. Peace.